Commodities versus stocks. When you invest in a stock, you are investing in a company's success. The price of the stock depends on how well the company is managed, how much profit it earns, and how investors feel about its future. Commodities do not depend on management decisions or company balance sheets. Their prices depend on global need and availability. This makes commodities less sensitive to company-specific problems and hence simpler to study. Even if a company is directly related to a commodity, its share price may move differently compared to the underlying commodity. Take, for example, a gold mining company. It may have limited access to gold mines, or maybe its cost of gold extraction is very high. Hence, even if the price of gold moves up, the share price may not reflect the performance of gold as a commodity. Commodities versus bonds and fixed deposits, FDs. Bonds and FDs are essentially loans. When you buy a bond or an FD, you lend money and receive a fixed interest payment. This makes bonds feel safe and predictable. However, there is an important limitation. When the prices in the economy rise, this is called inflation. The fixed rate you receive from a bond does not change. As a result, the same interest amount can buy fewer goods and services over time. Commodities usually behave differently. Inflation often happens because the prices of raw materials such as oil, food, and metals are rising. Since commodities are these raw materials, their prices often rise along with inflation. Example, if food and fuel prices rise, everyday living becomes more expensive. At the same time, commodities like oil or wheat also become more valuable. Holding these commodities offsets the loss in purchasing power caused by higher prices. In simple terms, bonds pay fixed money, but commodities move with real-world prices. That is why commodities are often called a natural protection against inflation. Commodities versus real estate. Both commodities and real estate are real assets, but they differ greatly in liquidity or how quickly they can be sold. Selling a property can take months. Finding a buyer, completing paperwork, and handling legal formalities. Commodity contracts, on the other hand, trade on exchanges and can be bought or sold in seconds during market hours. Real estate also involves transaction costs. Example, selling an apartment requires time and negotiation. There are large transaction costs in the form of stamp duty and brokerage. Selling a gold or crude oil contract happens instantly at market prices. Transaction costs are minimal. In our next video, let's find out why you should add commodities to a portfolio.